Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by Ball Guy from Ball Guy Money. Ball Guy, how are you?
Fantastic. Thanks for having me on.
Really looking forward to this, and we have a lot to talk about. We were just saying off air some of the topics that we should touch upon because they're quite poignant at the moment. I wanted to start with the sense of growing frustration amongst people that might be invested within gold and silver that might not be gold and silver bugs. I know that we've both seen and had comments about the fact that they're not moving as quick as they should do, and I want my wealth and so forth. What are your thoughts on that and what's going on?
You know, gold and silver, let's focus maybe on gold for a second because that's the one that's really got the most attention in the financial media, etc. And gold certainly moves a lot slower usually than other investment vehicles. Let's call gold an investment vehicle. I don't want to, split hairs on whether it's, money or an investment vehicle. Let's just call it an investment vehicle for the sake of this discussion. But it has these moments where it makes these really big moves up when it starts to price things in that probably should have been priced in earlier. It's when people start to come to the realization that all of these bad things they would have preferred to ignore probably shouldn't be ignored. Now, we're in what I said back in the beginning of May. I think it was the last week of April, beginning of May, what I had expected to be around a 4 month consolidation period for gold. So we're entering the fourth month of that right now. And this is something that shouldn't come as any surprise to anybody who's held gold for more than 2 years. Why do I say that? Just go back to 2024. When we really first started to break out, we were testing, 2,200, 2,300. I don't remember the exact level off the top of my head. And we got around April and we started consolidating, 4 month consolidation. And people were calling the top, saying gold can't hold the current level. It's going to come back to 2,000, even 1,800. The gold top is in. Get out of the market now. What happened after that, once we broke out of the consolidation period, which again, I'm saying we're in such a period right now, is we broke out to the upside, got above $2,500 an ounce, leading up to November and December 2024, when we saw 2 consecutive months of gold price pulling back, when once again, people were saying, this is the top for the gold market. This is it. The blow off top is in. Better sell your gold and get out now, get into, whatever thing it is that those people are emotionally attached to. And by the way, I'm not emotionally attached to precious metals, even though it's something that I talk about quite frequently online. It's just something that I have a lot of conviction for, especially for people who are looking for long-term preservation of wealth. So coming back to what I was saying, you saw November and December, you saw the price decline. You saw miners, which had put in really significant gains up to that point in 2024, start to come back as well. And I'm not trying to plug my Patreon service at all, but I remember a lot of people started quitting my Patreon service then. And I said to myself, this looks like a bottom signal to me. We're seeing some capitulation in the market. And what happened in really at the beginning of this year is we moved up again quite violently almost, not only past $3,000 an ounce, but we even touched at $3,500 an ounce, at which point people once again were calling the top. So we already had many market spectators and commentators calling the market top for gold on two separate occasions, where nothing fundamentally in the market has changed. If anything, we're only getting closer to the major catalysts for gold to make those next significant moves up. So for the people who feel like it's boring or whatever, do what you want to do. If you want to sell and get out of gold, I would never stop you from doing that. I would be one of the people who would be participating in purchasing the gold you're selling. The only thing is, you have to, if you zoom out a little bit, understand that at least by the first quarter of 2026, I still think we're going to see a bigger move up near the end of this year. But by Q1 2026, a lot of those people who are doing that are going to be kicking themselves and saying, you know what, I shouldn't have capitulated so easily, because clearly, once again, the fundamental issues that are at play, that those being currency debasement, a weaker US dollar, despite the bounce that we're seeing in the US dollar right now, it's a week into a bounce. Sure, we might be seeing a reverse head and shoulders on the dollar chart. We might be seeing a short squeeze for a lot of the people who had piled into shorts on the dollars. Fine, but it's a temporary move. And if you're really dedicated to building your wealth, you have to zoom out and understand that these types of periods are perfectly normal in order to flush out a lot of the weak hands, the speculative people who are entering, in my opinion, the precious metals market for the wrong reasons. And they'll be back, and the price will at some point march on and march up.
Yeah, I don't have a chart to hand right at this point in time, but I know that as part of the weekly wrap newsletters that I do, I've been saying for the last 5 or 6 weeks, it's just consolidating. Getting this sort of triangle wedge forming on the on the gold chart on the weekly, and yeah, I would expect that to go higher as well. I think the other thing to point out there, Bull Guy, is that we're also dealing with seasonality as well. Gold has never historically been super strong, maybe in May, June, and July. So I think that's another factor for people to consider. Point being, these things take time. It doesn't happen overnight like things can blow up in other industries. I think that's the point we're trying to make here.
Yeah, the seasonality is a great point. And this is precisely why at the end of April, first week of May, I was really warning people that, we're entering the summer doldrums. Not only are volumes lower, a lot of these institutional professional guys are at their houses in the Hamptons, and, they're living it up. And just in general, I think people look at life through rose-colored glasses during the summer period. So they're not really pricing in a lot of the things that could be catalysts for gold and silver to move up. We've gotten some positive economic data out of the United States today. And, um, you know, when it comes to the veracity of that data, that's probably another podcast, another call in and of itself. But I would just urge people to be patient, because gold and silver is not necessarily a bet like when you're purchasing a stock that earnings are going to go up, or that this company is going to produce some kind of innovative product that's going to increase the value of the stock. It's a very simple bet for, honestly, I would even say low IQ investors, that if you understand the concept of currency debasement, if you expect that trend, which we've seen since 1971 when the United States went off the gold standard, if you expect that trend to continue, which I think anybody with a pulse probably expects it to continue, then gold and silver should at least be a part of your portfolio. And nobody's saying that you have to go all in or treat it like a meme coin or anything like that. You also have to have the correct expectations when you're entering it. And sadly, a lot of people, starting from my generation, I'm a millennial, and then Gen Z, do not have the correct expectations when it comes to investing, because a lot of these people started their investing journey with the C19. So, 2021, sitting at home, nothing to do, get on the app, download Robinhood, Tesla does a 3x, Bitcoin does a 4x or whatever. And that is not what gold and silver are, despite the fact that they are performing fantastically well. That's not what they are. And you have to have a different set of expectations and understand it has a different role to play in your portfolio as a result of that.
You've mentioned the the C word, which has different connotations to a lot of people. Catalyst is the one I'm referring to. You mentioned the word catalyst a couple of times. I think it would be just very useful, although I appreciate a lot of people that are watching this might already know what they are. Just go over what the catalysts are that would likely favor gold and silver moving forwards, please?
Well, the pillar of my strong gold price thesis, which of course means silver was going to follow, was a weaker dollar. And it's been a weaker dollar for a long time. Now, people can, again, point at this moment in time and say, well, the dollar's rebounding, right? But what has the dollar done since 2023 when the Federal Reserve finished their rate hikes? You know, on a longer term basis, you're talking about a dollar decline. Now, this past weekend, I touched on something that I haven't heard anybody else talking about, and that is the history of the 1985 Plaza Accord. Now, for those of you, your viewers who are not familiar with the Plaza Accord, in the early 1980s, inflation, of course, everybody knows this bit. Inflation was really out of control in the United States. In the 70s, people used the word stagflation. So a guy named Paul Volcker stepped in, took over the Federal Reserve. And as I said on Sunday, he was kind of going to be the adult in the room, the guy who was going to make the hard decision. Okay, he was going to park the short-term gratification to the side and say, okay, we need much higher rates to kind of crush what is happening. And
Hmm.
he increased the federal funds rate so much that money from around the world was pouring into the United States in order to take advantage of these super high interest rates, because for them, they basically saw it as a fantastic low risk way to earn a yield on their cash position. And as a result of that, the US dollar index went to 160. Now, where was it at the height of, in 2023? We got up to maybe around the 120 level. So we're talking about levels significantly higher than anywhere we've seen in a long time at 160. And because of this, US exports became very expensive for people around the world. And the trade deficit for the United States, which was still important in the 1980s, a lot of people paid attention to it, was starting to balloon as Americans were using their strong dollars to purchase what were relatively cheap goods coming out of Japan. And the Japanese were taking those dollars in turn and starting to purchase assets in other countries, including the United States. And, people who are my age, a little bit older, will remember that there were people spreading fear saying the Japanese are buying up the United States. Okay, so that was the situation. So in order to remedy this situation, they had the Plaza Accord. The leaders of the biggest central banks, they met. It was UK, Japan, France, United States, and then they went to the Plaza Hotel. That's why it's called the Plaza Accord, and they agreed that they would intervene in the foreign exchange market and that it was okay to do so if a currency got so strong that it disrupted the normal balance of trade in the market. Okay. And the dollar devalued very quickly, once again, making US exports attractive to these foreign countries and bolstered a little bit of economic activity in the United States, along with, of course, the subsequent rate cuts that eventually followed. Now, people might think that this doesn't mean anything in 2025, but what they forget is that Donald Trump, the current president of the United States, purchased the Plaza Hotel in 1988. He was the owner. And if you've ever seen Home Alone 2, you've seen the scene where Kevin McAllister, played
Hmm.
by what's his name, Macaulay Culkin, asks for directions from and it was Donald Trump, right, who was the owner of the Plaza Hotel at the time. And to think that Donald Trump does not remember the history of the property that he once owned, that is very fresh in his mind. And what was he quoted as saying recently? He says, a strong dollar, this was just last week, by the way, a strong dollar sounds great, but you make a heck of a lot more money with a weak dollar. And associated with his agenda to bolster US exports, manufacturing, etc. And I don't know how successful that is going to be today. I don't want to judge things like so many people are so quick to make judgments early on. I'm not one of those kinds of people. But I think this is an element. He has that history of the property that he used to own fresh in his mind to say that is something that helped boost US exports. And by 1987, which was, 85, 86, 87, once you start to get to the end of 1987, so about 2.5, 3 years after the Plaza Accord was passed, is when you really started to see that US trade deficit come down. And that's something that I think he wants to address. I think that's something that we can count on. And that is what one element that is going to fuel gold and eventually silver and other commodities, by the way, to the upside. Now, let me just add one thing to that still, because there's a big difference today versus what happened in the mid 1980s, and that is where interest rates are. Interest rates, even after they were being cut, were still around 7, 8% at the Fed funds level. Today, we're at 4.25, ready to make that lower. And people will say, well, the market is what dictates the interest rate. But at the end of the day, what we're seeing, even today, I've seen news coming out of the US Treasury of them taking action to do what I could only interpret as yield control. So it's trying to artificially step into the market, which is something that also quantitative easing can achieve. And I have said that I would expect to see that at some point in the future to get those yields down if the market continues to demand such a high rate of interest on those longer term treasuries from the United States. As those interest rates go down eventually, that means there's a lack of real alternatives in the market for people to earn a yield on their money. So what are they going to do? There's going to be a large part of the market that says, well, I'm probably just safer being in gold. Central bank demand is bolstering price. They're not likely to sell anytime soon. And this is just another level to that. You could call it the same. It's the same thing, but it's another layer to that's going to push, again, gold and silver higher still over the next few years. I think we're only in the early days of this bull market for gold and silver and for hard assets and commodities at large. So that's what I have to say.
No, that's great. And thank you for deep diving into that. I think there's a couple of things to unpack there. First of all, I'm not going to sit here and get on any form of political high horse or spectrum. What I would say about Donald Trump and the administration is that they have been very clear with regards to fiscal policy. That's what I will say. They've been very, very clear, like you quoted, well, like Donald Trump said the other day about a weaker dollar. Are they going to monetize the asset side of the balance sheet? Well, they've said it. I believe they will. And that shouldn't, if it were to happen, that shouldn't catch people off guard. Now, I know there's a bunch of other stuff people will point to and say, well, they've not done this, they've not done that. That's politics, that happens, or whatever. But the point I want to make is that I think Trump and his administration have been very clear on fiscal policy, what they're looking to do. Secondly, going back to yield curve control and stealth QE as well. Yes, I think that's a very valid point now. I'm glad that you brought that up because a lot of people just look at QE and say, well, this has got to happen or this is happening. And once that happens, all hell breaks loose. But actually, they're sort of doing it. But like you said, they're sort of doing it stealthily. And I think not many people are aware of that at the moment and the benefits that could have for commodities moving forward.
Yeah, I don't think the market is really pricing many things correctly and haven't done so over the last few months in specific. Let's put the stealth QE to the side. Let's talk about the tariffs for a second.
Mhm.
When the tariffs were threatened to be implemented, the price of metals were going ballistic, right? And now that the United States has made a trade deal with the European Union, I don't know how great a deal it is. That remains to be seen. I saw the German economy uh, shrunk by 0.1%. I don't think these tariffs are going to help it that much. So that means at least Europeans are going to be seeking um, a little bit of shelter from potential inflationary pressures as the ECB, the European Central Bank, lowers interest rates in order to offset the impact of these tariffs. Now, what I wanted to say was the European Central Bank was supposed to, we're at the end of July right now. I don't know when this is going to be shown, but they were supposed to lower interest rates in the month of July. They were expected some time ago to, lower interest rates. I believe they were supposed to bring the target rate down to 2%, and it's at 2.2% right now. But they held off on that decision. Why did they hold off on that decision? Well, they used the tariffs, the fact that they didn't have a deal with the United States as kind of an excuse to hit the brake. Well, guess what? That barrier to lower rates in European Union has now been taken away. So why is this all of a sudden bearish for precious metals? Maybe over the short term because you're pricing out some of the market uncertainty, but over the long term, as rates in one of the largest economic zones in the world continue to come down as they artificially try to bolster the economy, that's going to have debasement and inflationary pressure on top of all the military spending, by the way, that they've just committed to during the meeting that they had in the Netherlands with Donald Trump when they had the NATO summit, right? And all of that is at least inflationary for Europe and Europeans, meaning that all of those, what is it, 600 million people that live in that zone, in the Eurozone, are going to have additional incentive to continue to stack precious metals. And even with the price of gold today down in US dollar terms, we're seeing the price of gold rise in euros because it's being offset by euro weakness. And of course, if that continues, again, the gold didn't have any problems at some moment in time rising along with the DXY. Gold hasn't had any problems since 2024 rising with the stock market. You have to park these biases to the side and understand that there are greater factors at play. And I've heard, I watch Mario and Echo over at Manico 64 from time to time, and he was talking recently about a crack up boom. Certainly, that is something that you could consider, that you could label this as, because people are concerned again about the continued devaluation of their currency, and they see, especially the smart money, they see what's coming around the corner with programs, as you said, that are being labeled as stealth QE.
Are there any other catalysts that we haven't yet touched upon that you think people need to know about, or is it the main one being the devaluation of said fiat currencies?
Well, it's kind of a race to the bottom for these currencies, right? Because, if tariffs come into play, then how do you offset some of the impact of the tariffs? If you're China, if you're in the European Union, you try to devalue your currency, right? And if that's an element of also the United States strategy while they're at the same time implementing these tariffs, then that creates an environment where you could see a massive debasement of fiat currencies around the world. And what have central banks been preparing for? And that's an additional element, this central bank buying. I understand it's slowed down as of late. And maybe we're in a pullback right now where the price of gold might test 3,200. And let's see what the central bank appetite is once we pull back to those levels, because I think they've been preparing for precisely this situation. And, when you're talking about a central bank, you're not talking about some kind of hedge fund manager that's looking to make a trade and make a profit on this. So that's supply from the market that's being sucked up and not re-entering the market, right? These are, what the crypto guys would call diamond hands. They are literally the epitome of diamond hands when it comes to gold. They're not looking to sell. Even if they've tapered their purchases as of late, it doesn't mean much because they continue to purchase. So of course that's another element of it, and I think those are really the main factors at play.
Well, we saw, I think it was a couple of weeks ago, that gold overtook the euro as the second largest reserve, I think, in the world as well. So yes, they're certainly trending. Was it do what the central banks do, not what they say, yeah, is what I like to say.
Why aren't
Really,
they why aren't they building reserves in their fiat currencies if they're so great?
no, absolutely, 100%. That's
They're printing up the fiat currency. They're printing up the fiat currency, and then what they're doing is they're just buying the gold. I did a video of about this, some time ago. I think it was about 18 months ago, maybe even as long as 2 years ago, where I said, is that the real confiscation? Now, I'm not trying to be alarmist or anything like
Hmm.
that. I think I'm one of the people who has a bit of common sense in the precious metals field, but maybe that is confiscation by another name. Give people the incentive to part with their gold because of higher prices, which are in part being driven by the printing up of money and the exchange of that money as once it's printed, that's when it has the most value still, right? Because it hasn't worked its way through the system, and
Hmm.
exchange that for gold in order to bolster your reserves and something that you understand over the long term is probably going to protect your balance sheet a lot better than holding the fiat currencies.
In terms of where we are at the moment, and again, people put different time frames on what's going on, what's happening, how long these things can take. Just want to go back to the point about patience. And we could be sat here talking today as we are, and we could have the same conversation in 5 years' time, and there's been movement, and yet we're still in a roaring commodities bull market. So just wanted to get your thoughts on where we are and how long you think this could potentially play out for.
Well, for your viewers who are not retired or preparing to retire right now, you have to ask yourself the question, am I going to be in the workforce or, saving, preparing for my life and my golden years for 8 years or more? That's really a big question. 8 years. And why do I put the 8 year time frame on that? Excuse me. So I would say the 8 year time frame comes from the fact that when you look at a lot of the social safety nets around the world in the big economies, and I'm including China there as well, what you're seeing is specifically for these large groups of people who are older, because the population pyramid is kind of upside down right now, isn't it? The population pyramid is standing on the tip of the pyramid, meaning that there are a lot more older people than younger people, which is a bit different than it used to be. And by the Congressional Budget Office, and I'm going to use the United States as the example here because I've got a lot of data to talk about that. The Congressional Budget Office themselves say that the Social Security Trust, which pays, out Social Security benefits, is going to become insolvent, basically run out of money by 2033, which is 8 years from now. 8 years from now, at which point benefit recipients are going to have to take a 25 or 26% cut in their benefits. Now, maybe I'll ask you a question. I'm on your show, but I'm going to ask you a question.
Mhm.
Do you see a future where the politicians in charge are not going to print the money to fill the gap?
Not under the current system that we have, no.
Because I don't. Which means you have the potential. It's not a ticking time bomb for retirees. I think what they'll do is just, as they've always done, kick the can down the road. And what I'll say is, people from my generation, the millennial generation, and let's look at the Gen Z as well, they have a lot of hate for boomers. And I understand a little bit of the frustration. There were boomers who were warning people that our children and grandchildren were going to have to pay the bill for all the spending that was being done in the late 80s and early 90s in order to fund a lifestyle that might have been a little bit more than what they could afford, right? And all of these benefit programs. But I don't think people in my generation or the Gen X generation are going to behave much differently. So I'm going to give the boomers a bit of the benefit of the doubt here in that I'm expecting massive inflationary pressure and moving forward. And I think that once we get 8 years out, which by the way, I think the Congressional Budget Office is kind of being optimistic here. That could end up being 7 years, 6 years, or even 5 years before that problem starts to materialize. At which point, once again, as I've said, the money is going to be printed to fill the gap. You're going to see, much like we saw in 2020 and 2021, the cost of living is going to continue to spiral out of control. And the people who are going to benefit the most are going to be people who own hard assets. And it's not only gold and silver, it's also people who own real estate, right? Because, how many people say, oh, yeah, the boomers bought their house for 5 buttons back in 1970 and now selling it for $1.5 million in 2022, right? You see these memes on the internet. It's just going to be a repeat. And that's why really a pillar of my message has been since I launched my YouTube channel back in 2021 was position yourself in hard assets, at least, majority hard assets. That doesn't mean, don't take a punt, don't take a risk somewhere else, but don't treat it as a casino, because if you can really be focused on building your hard asset portfolio over a period of 30 years, you're going to benefit from the trend that we've just seen cause a major acceleration in the price of hard assets. And that's going to happen once again. And just to kind of come back to your original question, I see, even though we're only in the early days, and I think we probably have, at least 2 or 3 years more for this leg of the hard asset bull market, I think then we might take a breather. I'm talking directionally, right? After which time you're going to see maybe a 2, 3 year breather. And then we're going to pick up again as this issue with the solvency of these national pension programs. And when I'm talking about national pensions, I know a lot of Americans get a little bit lost when I say that, but Social Security is a national pension program. It is a pension that they pay to old people in their retirement in order to kind of keep them going. And a lot of people are living only off of that Social Security right now. And I don't expect that trend to change, by the way, because human nature isn't changing. In fact, if anything, human nature is getting worse, making people more reliant on the government, meaning as they intervene more and more in the market and stifle real economic growth through their actions in the market, it's just going to create more need for them to intervene in ways that we saw them intervene in 2020, 2021, and 2022 with a massive injection of liquidity in the market. It's going to continue, and that's going to happen once again. 8 years out is approximately the number if you take the Congressional Budget Office at their numbers at face value.
Well, you mentioned there about relying on the government more and more and more, and that's a very good segue into CBDCs and stablecoins because there was quite a few very important, I say, bills passed in the last week or so at the US Senate or government over there in the USA. And I know you've done a piece on a recent video that you've done as well, but just as layman terms as you can, what do these bills passing likely mean for, again, precious metals moving forward?
I am bullish on precious metals because of what these the passage of the Genius Act really means. And I know a lot of people might not get that, and I'll explain it in a moment, but it's not only precious metals that I'm bullish on. Of course, as I've said, it's all hard assets, and I'm going to throw in there, maybe controversially so, for some of the people who are more precious metals oriented. I still believe that this is going to have positive impact for Bitcoin. So I've made my statement on what I think is going to benefit from this, but let me explain why. A stable coin is, let's say, a fiat currency in its digital form. And they're currently being used by many people around the world, especially in the crypto space, at least for now, to have liquidity parked in to eventually take advantage of, let's say, you see a dip in the price of Bitcoin. I've got some money parked in stable coins. I'll buy that dip. The price goes up. I take out my profit, I keep it in stable coins, and I rinse and repeat, right? This is kind of a cycle a lot of the crypto traders are following. What sits behind these stable coins, and look, I'm not saying these stable coins are very trustworthy. There are a lot of questions and doubts when it comes to the books at some of these stablecoin companies, specifically Tether, in that they have been accused multiple times of creating more stable coins than they actually have reserves to back up, okay? Which is, by the way, an inflationary force
Hmm.
for the digital asset world. But, you know, coming back to where what this Genius Act does, it kind of pushes these stable coins into the mainstream where people aren't only using Tether to, go in and out of Bitcoin anymore. You might see a situation where you start to see stores, shops accepting stable coins as a means of payment because it's easy, it's fast, it's cheap. And I have admittedly used stable coins instead of using the banking system to make international transfers in the past. Again, because it's cheaper, it's easier, it's faster. Okay. I'm not saying I'm holding money in stable coins because that's like holding money in fiat. And because you have an additional layer of counterparty risk associated with these companies managing the stable coins, that's something I'm not willing to hold for a long period of time. But there are advantages of it to it. And as they become more mainstream, you're going to see these stable coins circulating within the regular economy. But the one thing that people don't pay much attention to is the fact that every stable coin, in theory, now, at least according to this new legislation, has to be backed up by something. So Tether will receive a dollar from somebody who wants their digital dollar, their dollar stable coin. And what they do with that dollar is they don't just put it in a safe and keep it there and say, okay, we have it backed up. They take that dollar because they're a company and they purchase US debt, treasuries, and bonds. So they've been basically green lighted to create a dollar in the economy in exchange for a real dollar, while at the same time taking that real dollar and lending it to the United States government, making $1 $2. Okay. So that's what a lot of people have to understand is that there's this multiplication effect. And today, if we look at how Tether backs up their Tether stablecoin, 2.3% of that stablecoin is backed up by gold. And I do think that there is a place for gold to kind of play a role in backing up these stablecoins in part, which is one element of my bullishness for precious metals moving forward. We'll come back to that in a second. But 79% of what Tether holds on their balance sheet as the backing up thing for their issuance of these stable coins are US treasuries. Now compare that to about 11% of US treasuries backing up US bank deposits, right? So for every $1 a large US bank receives, 11 cents of that money is then lent to the US government. But remember, if you've deposited that dollar in the bank, you don't have access to it. You can maybe spend it later on if you want, but it's not actively circulating within the economy. It's been parked in the bank. Whereas when you give the dollar to Tether, not only now are 79% of those dollars being lent to the US government at a much higher rate, which creates a huge incentive for the US government to rubber stamp these stable coins and take that money and then spend it in the real economy. That dollar isn't parked in a bank account somewhere. You've been given another dollar in exchange for that paper dollar that is now circulating once again in the digital, or eventually in the future, once more people start accepting these stable coins, in the real economy, which means you're going to see the money supply expand as long as they start counting these stable coins in their money supply calculations, by the way, because that needs to be correctly adjusted for. But we're going to see a much more rapid expansion of money supply as a result of that. And we know that the very definition of inflation is money supply expansion. It's not prices going up. sometimes we use that term loosely. Okay, what was the inflation rate this year? How much did prices go up over the last 12 months? And I get that. And I'm not trying to split hairs. I know some people in comment sections and videos, they love to split hairs about that kind of stuff. It's stupid. It's a waste of time. But inflation is really the expansion of the money supply. And this has the possibility of causing a massive expansion in the money supply, causing massive unintended consequences that I don't think people have properly factored in to their projections as things stand today. Why is that? Because the US government, who has had some difficulty recently selling their bonds, we've seen some less than stellar bond auctions as people around the world are a bit hesitant to lend money to the US government. And we're seeing central banks, like the Chinese central bank, most notably, trim their US Treasury position from it was more than, I think, $1.2 trillion a few years ago to now about a little more than $600 billion. So the US government is seeing these stable coins as, hey, every stable coin that gets purchased, we get 79 cents out of every dollar. This is going to fill a huge gap we have, especially if we can kind of legitimize these and get these working in places around the world, because that just increases the demand for these stable coins. Now that we've kind of given a stamp and said, look, these stable coins are safe, money is going to start pouring into stable coins. It's going to make life for people around the world much easier to start using them. And at the same time, guess what? It fills a huge gap for us. But once again, I don't think they have taken into proper consideration the impact this is actually going to have on circulating money supply as they spend every single dollar that pours in the form of lent money to the government, while at the same time that digital token that they've just rubber stamped and said this is okay, we accept this in the economy, is circulating in the economy. Again, you're basically turning $1 into two.
I'm glad you mentioned treasury demand there, because that's the first thing I had in my head when you started to explain that. I'll play devil's advocate and say I wonder if they have done all this because they know what will happen and then they'll revalue gold afterwards, just as a devil's advocate point. Unlikely,
I
but you
mean,
never know.
I don't have a strong opinion on the revaluation of gold in the traditional sense of what many people present it as on YouTube. What I say the revaluation of gold will most likely look like is that the United States government simply says, we have all of this gold on our balance sheet. It's valued at whatever $42 an ounce today, 42.50, whatever the exact number is. And if we can just mark this gold to market at the whatever $3,300 an ounce it's trading at right now, that makes our debt to GDP level look a lot more attractive.
Mhm.
Simultaneously, I mean, they're not stupid. They know that by doing that, you basically put a hard floor in on the price of gold. So everybody in the market looks at that and says, this is what they say the price of gold is now. I have no downside risk at today's price buying gold. I might as well buy it because, as I've argued in the past, the market has been aggressively revaluing the price of gold all on its own without any government intervention at all, basically since 2000, when the real, long-term bull market for precious metals started. So you don't really need the government to come in and say, yeah, it's $10,000 an ounce or $15,000 an ounce, because they know very well that by doing that, it's a repeatable process where they can continue to market up to wherever the market price is, further decreasing their debt to GDP as the market kind of accepts what I've called as what I've called a renaissance in precious metals as money.
Well, and as you said earlier on, it's almost like they're kicking the can further on down the road, but they seem to be getting smarter at doing it. Dare I say? Probably famous last words there, probably for myself. That's the feeling I get from everything you've just explained.
The Trump administration has more people from Wall Street, I think, than any other administration in the history of United States presidents. And I think that is by design, in that taking over the reins from President Biden, and by the way, I've been critical of every single administration um, that's existed in my lifetime, basically, for bad decisions. So I'm not trying to take political sides here, but they took over, what was a very bad, I would say, situation where that administration was really trying to prop up the economy, entering an election year with government spending, government hiring, and really running up the debt in an irresponsible manner, the likes of which we've never seen. So they know that there's some cleaning to be done and that it was going to be difficult. And how do we know that is because Janet Yellen, as she was exiting her post as the US Treasury Secretary, was basically saying, hey guys, you have like a month or two of money left and, deal with it, mic drop, and just walked away, right? And I mean, you don't have to be a Democrat or Republican to look that up as a fact. That was a fact. That really happened. So I think, they brought in a lot of these people to as kind of consultants, advisors to say, how can we keep the market kind of pacified while we take steps to continue doing, by the way, what we've always been doing,
Mhm.
but also structurally change a few things in order to potentially make things better. And I think that was really the main reason why they brought in a lot of people from Wall Street, which, it also makes you ask questions when it comes to some of the original market sell-off that we saw back in April, and then some of the tweets we saw following that resulted in major market recovery. How many people were associated with making money in that? You might like what's going on right now. There are a lot of things that I like that are going on right now, but that doesn't mean we can't ask any questions about, maybe these guys knew a little something that we didn't know, as politicians, by the way, from both parties have always benefited from. So, coming back to the main point, I think that they are doing this in a much more clever way. And I think it is by design, in the sense that they've taken on all these people from Wall Street to kind of pacify the big money people that have the most ability to influence the direction that the market moves in.
That ball guy thing again. Thank you for what I would call putting that into layman's terms. To say I'm sitting here nodding like a Cheshire dog or Cheshire cat, whatever the phrase we use in the UK is, because I'm agreeing with it because you're making it sound very simple. So thank you for doing that. I really appreciate that. We've covered a lot today. We've spoken about obviously gold, silver. These things take time. Obviously, a potential 8 year limit there, depending on what's going on. We've also looked at stable coins and the fact that that's going to increase the money supply, which would of course have inflationary effects and so forth moving forward. Is there anything that we haven't covered that you would like to talk about before we wrap up?
I suppose it's just the mentality of people who are watching this. I've been posting videos about gold and silver. I really started to lean into the gold and silver topic, I would say, in 2022, as the rates were going up and we were seeing metals bottom, because I really saw an asymmetric situation building for precious metals where it was a you can't lose situation. And I've been very passionate about communicating that, not because precious metals are the only thing that I'm invested in. I own real estate, I hold some Bitcoin, and, plenty of other things in my portfolio. But this was really one of the things that I saw as being asymmetric, in that I didn't think you could lose. And there are moments in time, like November and December 2024, when you get the market taking a rest, a pullback, cleaning out some of those more speculative traders, some of the weak hands, people who entered for the wrong reasons. And, people's mentality, it just changes on a dime. And I absolutely have to encourage people who are watching this to just continue to analyze your investment thesis when it comes to holding gold and silver for a long time. And the investment thesis here is that governments are going to continue to spend more than they take in, and that as a result of that, they have to print the difference, and the fiat currencies that precious metals are denominated in, let's say, are going to rise in price. And what we've seen basically since 2000 at a rate outpacing inflation, especially in the case of gold. And don't be discouraged by short-term pullbacks in the market, even if they last, consolidation periods like the one we're seeing right now, or that one that we saw between April and August of 2024. This is a marathon. And if you have any plans on having a comfortable retirement and living off of something more than a national pension, meaning also Social Security for the Americans viewing this video, you need to get on a long-term plan and ignore the volatility. In fact, the volatility, from your point of view, should be a blessing. It should only be seen as an opportunity to get more of the very thing that you're going to need 10, 15, 20 years down the line. Because too many people track their portfolio on a day-to-day basis. And then they come to my videos, and I've been saying, by the way, gold bottomed out around $1,600 an ounce in 2022. So it's doubled, more than doubled since then. Yet you have a 3 or 4% pullback in the market, and people come to my channel, to other people's channels, and they make the comments, you're a loser, it's going down. That is the mentality. If you found yourself in that habit, that is going to cause you to make too many short-term bets in your investing life, which, just like a casino, the odds are in the favor of the house. And there's a reason why 97, 96% of short-term investors lose money. This is not a game that is working in your favor. And instead of trying to get rich quick, I would encourage everybody to listening to this podcast to get on a plan that suits them, adjust your lifestyle. Don't worry about what your neighbor's doing or what the guy you just saw on Instagram is doing. Get on a lifestyle that you can afford that allows you to slowly save over a 15 to 20 year period, because you're going to be grateful for that later instead of paying attention to short-term volatility. Short-term volatility is noise. But when you zoom out on a 25-year chart, that's the signal that you're really getting. And anybody who is a real serious player in business, and I've heard this about Steve Jobs, I've heard this about Elon Musk, whether you like them or not, it's that these people have a tendency to focus their attention on signal as opposed to noise. And that's what investors and people planning for the long term need to do. They need to zoom out, and they need to understand short-term pullbacks are noise, long-term trends, and a proper investment thesis built on an idea of something that you have seen to be true and expect to continue to be true is signal. And that's what you need to focus on. And I'm sorry to be a bit preachy here, but we are experiencing a bit of, pullback in this consolidation period right now for precious metals. And I just am seeing so many people giving up right now. And I think just like people who kind of sold the bottom for gold in 2014 and 2015 and 2016, that 3-year period, are kicking themselves today that they weren't scaling up on their position. I think that there are a lot of people who are getting negative on the space right now that are going to regret that decision a few years from now, maybe even not a few years from now. It could be as a few months from now. So, just focus on that investment thesis and focus on the signal and continue to do that. And I'm certain, especially when you're talking about focusing on hard assets, considering that 8-year deadline that I've given with respect to the Congressional Budget Office's own admission that the Social Security Trust Fund is going to be going broke, understand that more money printing, if it doesn't happen in the immediate short term, it is going to happen over the long term, and that owning hard assets, including gold and silver, is a way to get you to what I like to call the promised land, which is simply a comfortable lifestyle in old age.
Fair enough, and don't worry about being preachy because I think we both find it very important in order to be able to share our opinions and educate because we I think we agree on pretty much everything that you've said today, Ball Guy. I always like to give people the chance to say how they could be found, and again, I'll caveat this by saying Patreon and X and so forth. Whatever you mentioned, I will put links into the YouTube description and also the Substack post that comes with it. So the floor's all yours. How can people find out more about you and get in touch with you?
Go to YouTube, type in bald guy money. I post one video every Sunday. I'm not one of these guys who's posting every day or 3 times a week. I do one video a week where I'm presenting what I really think, and many viewers agree on this, is the most pressing information and news in order for people to properly assess precious metals and macroeconomics, today and moving into the future. The videos are only about 16 to 20 minutes long. It's not a big investment of time, but I think all of your viewers will find it valuable to spend the time there. It doesn't cost a penny, YouTube. And then YouTube is there, for people if you're not paying for premium. It's all you have to do is watch a few advertisements there. And that's a great way to get started on me, on what I do, on what I talk about. And I think it's worth your viewers' time.
No, I would also recommend following yourself on X as well. And again, I'll put your Patreon link. So I know you mentioned it at the start. I'll put that link into the Substack as well for people that want to go, more in depth into what you do and what you talk about as well. Paul Guy, I've really enjoyed this. I've got a lot of mental notes that I need to scribble down. Thank you for your time. It's been an absolute pleasure. I look forward to catching up in 2026.
Cheers, brother. I don't do these shows very often, but you're a really nice guy, and I really enjoyed this conversation, and I would love to do it again in the future.
No, I look forward to it. Well, stay safe, keep well out there, and look forward to catching up soon.